Our chief equity strategist and economist, John Blank, says the S&P 500 may not reflect the U.S. economy, but the broader stock market does. John's here now to expand on that for us. John, what does that mean?
Yeah, basically you got to understand that the S&P 500 is dominated by 5 to 10 stocks that are big tech stocks. We all know this. This is Microsoft, this is Amazon, this is Apple, this is Google, this is Facebook, this is Netflix, and frankly, MasterCard and Visa and a few other names. But the problem is, of course, that giant tech companies with big footprints aren't the U.S. economy for most people, and that's the basic point.
So there's something going on that you refer to as historically high S&P 500 index concentration. So is that what you just described?
That's it, Terry.
Recently, S&P 500 broke above its late February highs, notched fresh highs, same for the NASDAQ composite. Most of those gains driven by the strong big tech stocks that you just described. But that is not showing up in the wider breadth of the stock market, as more stocks were down than up overall. Is that a little concerning to you?
Well, again, if we want to get a stock market that reflects the economy, we need to extract these major tech stocks, and that actually ends up showing us that the equal weight stock market indexes are actually reflecting this economy. And yes, if you find that actually your other stocks aren't doing much this year or haven't recovered their highs, that is what we're talking about.
So what should investors take away from this then?
Well, the story of the coronavirus is a dynamic one, and they need to keep in mind that the market is betting on a number of vaccine stories that clearly can be supplied with biotech advisory knowledge, and smarter money than you is out there. So just be patient and let the turn happen.
Market also seems to be reacting positively to news that the number of new coronavirus cases continues to decline in the United States since spiking, and other seemingly positive developments on that front. If positive news continues out on that, is the U.S. going to be viewed as maybe one of the safest places in the world?
It's not one of the safest places, but it will allow the U.S. to begin to join the international economy, tourism, plane travel, bookings abroad, even cruise ships eventually. But the basic point is everybody's going to get a lot less cautious, and that's good for the market.
And so then we can expect to see more capital start flowing into the U.S., causing stocks to rise further?
That may not happen, given that has already happened. But it will remain to be seen on an equal weight basis whether that happens. And that's where I'd look for that to happen.
So then, just to recap, is the tech rally and the COVID news actually the drivers of the market right now?
Yeah, I think so, Terry, but in new ways. And don't get static and you're thinking about what that tech rally and COVID news is going to imply. It's going to be dynamic and it's going to change.
Going on as we speak here, John, is the Kansas City Fed's annual summer Jackson Hole central banker discussions. This year, it's a virtual event for obvious reasons. Symposium theme, navigating the decade ahead, implications for monetary policy. Fed Chair Powell's speech, titled Monetary Policy Framework Review, may actually be the most watched here. He talked about a new approach to inflation during his speech. Are you looking for some of the same things as that conference wraps up that Wall Street is looking for?
Yeah, basically, just so people understand what Powell's drove at, he called for average inflation targeting and a less aggressive approach to unemployment. So what people need to understand about the Fed, speaking as an economist, is they have a dual mandate. And this is statutory. This is meaning a statute that created the Fed. It puts this in language, written language. They have to keep inflation low and seek full employment. So what they're doing is creating new language to attain their statutory goals. The new language is average inflation targeting over a long period of time. And what that implies in this situation is we're at 1.4% on consumer price inflation after food and energy. And that it means we're below the 2% mandate. So what it says is that over a number of years, over the next decade, if we do 1.4, 1.4, 1.4, 1.4 for the first half of the decade, we can do 2.6, 2.6, 3, 2.6 for the second half of the decade. In other words, they're going to let the inflation rate burn hotter than before because they're going to use this average inflation targeting concept. Furthermore, on the labor market side of their mandate, they are also going to tolerate more aggressive full employment targets so that they can get the unemployment up, the wages up, and therefore the consumer inflation up. So generally speaking, this is bullish stocks because it keeps the Fed rates and the accommodation in the game for longer.
And as note to our listeners, papers and other materials are going to be posted on the Kansas City Fed's website, kansascityfed.org. So if you want to refer specifically to Fed Chair Powell's speech or any other material, you can go there to check it out. But I often wonder, John, why do they hold this event during the dog days of summer?
Well, two reasons. One is it's nice to be in Jackson Hole this time, and the old Paul Volcker days. Paul Volcker was a fly fisherman, so it was the way to get Paul Volcker to come to a conference. But it truly was. And what happened over time, though, is it also fills a schedule where people are really not. There's no news cycle out there in the stock market. There's no earnings. There's nothing. So they also learn that they can give the Fed visibility to the market this time of year and give people some more longer term instruction like they're doing. So it's evolved over time. And other thing to understand is they also get a fair number of international people who fly in typically for this event in Jackson Hole. And that it has proven to also be a good time to bring in people from outside the country to this event.
Interesting. So to go on to a different topic here, because we're coming up short on time, you're looking at three major American brand stocks right now: Deere, O'Reilly Automotive, and Whirlpool Corporation. Why these three now?
Well, let's talk about these three stocks, Terry. I mean, let's talk Deere Company. We all know this is the big tractor guys. $210 a share, value score of F. O'Reilly Automotive, a Zacks number 2 ranked stock, $464 a share, but a value score of actually B, a fairly attractive stock at these levels, which is interesting. And then there's Whirlpool, which is a number 1 ranked stock, $180 with a Zacks value score of A. So interestingly enough, other than Deere, these stocks are not actually overvalued, but the price tags are unbelievable. So this leads me into a level of interest because you generally think to yourself, unless you own these stocks already, maybe you don't want to put new money to work because of the price tags. But if you're going to, I would assume O'Reilly Automotive is probably the best in terms of what our system is saying.
All right. That's the latest from our chief equity strategist and economist, John Blank. John, I'm Terry Ruffalo. And also, don't forget to check out Zacks.com/promos page for an interesting offer for your consideration.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.